All right. Well, it's time to get fresh perspective on this market. How should we be looking at our investments in what has been a very range-bound scenario over the last couple of weeks? George Heber Joseph, Chief Investment Officer and Chief Executive Officer, Equity at ASK Investment Managers, is with us. George, good morning. Great to have you join us. I want to start with this decline in metal stocks. Something has started bothering metal names. What do you think is going on over the last couple of sessions and weeks?
So the dream around metals have been going on quite for some time. The reflationary trade has been, very buoyant. But what we have been believing is that, ultimately the valuation makes a big cut while managers look to invest. So we are completely away from metal pack because first of all, we didn't participate in the rally in the last few years because we want to buy value-added businesses which actually makes a difference in the lives of people. And that is where we intend to invest and where the ROEs are better, the long growth trajectory is visible. So we generally try to avoid the metal names. We try to create proxies for that. So as we speak, we are quite constructive on the cap space because that is where the valuation looks very attractive. And also, the macro fundamentals, as per our data, what we analyze, has improved substantially in the last 15 days. Therefore, we see a good run up in the markets possible at this point in time, especially in the large caps.
That's an interesting one, George. So, what is this macro data analysis that is giving you the confidence that we could be turning a corner here on the overall market? Tell us more.
Yeah, so first of all, the crude has eased off. That's very, very clearly visible. Secondly, if you see, dollar index also is behaving well, which is positive for Indian index. And India has underperformed the emerging markets significantly in the last, the trackable periods that we could see. It is one of the best performing market in the entire emerging market space, which is also gives you a cushion in terms of FI money coming in, where it can come, or ETF money can come in, where it can come. It could be more to the large cap space. And that's where the FI exits have happened. And because of which the valuation cushion has built up. On a trailing basis, if you look at Nifty price to book valuation is around 2.9 times, which is in the recent times one of the lowest point, which again gives you a good cushion to the valuation from a Nifty 50 standpoint. Whereas small caps and mid caps have not corrected enough to the extent, the valuation differential when we look at from Nifty mid caps and small caps. I think it is one of the 2-decade low valuation differential in Nifty 50, which is visible. So, which we have been telling our investors, saying that this is the time to skew your portfolio towards the Nifty 50 basket, and what we have done in our client portfolios.
Okay, so you have a large cap bias, George. So, what in large caps? Is it more financials that you are convinced of at this point in time? Power, metal, you said you don't like, because large caps, I guess, the bulk of it is financials, right?
Yeah, so financials, if you see private financials as well as large PSUs, also when you look at, they are trading at a ridiculously cheap valuation. And especially banks, as you know, it's a clear macro trade. If the macro improves, the money comes into banks. And when macro was actually when money was going out of banks as well. So FI is a complete seller of financials in the last, many months and quarters. And we believe that that has created a lot of cushion in the financial space. As you right pointed out, it is the private banks, if you see, the large private banks are trading at 5-year low valuations, zero returns in many cases for the last 5 years. So it has created a lot of cushion there, which looks very attractive to us.
And George, do you believe that the financials at this point in time, banks and NBFCs, are they already factoring in the stock prices, that is, are they already factoring in some deterioration in asset quality because of this war? Are they already factoring in that the cost of money will probably go up if the RBI hikes rates?
So in historically, we have seen that, big crisis situation, is emerging because of global situation as well as, domestic situation like this, because of energy price, war kind of situation, Ukraine scenario, all of them, eventually boils down to the fact that how the companies control their cost and, improve their business situation. So most of the times, companies have readjusted. Mind you, next 2 quarters can be challenging, but market will look through these situations when the proves. So, from a banking sector point of view, you should see a couple of quarters the NIM compression be present, and plus the NIM expansion for some of these companies. As you see the mortgage book getting repriced, you will see that that can benefit some of these large cap banks. So many cases, what we feel it is quite attractively positioned pack is the large caps, where you can see a good rally possible, especially the Nifty 50 bucket. Whereas in the small and mid cap, we're very selective in what you pick and choose.
Okay. So expand on that point, George, that, small and mid caps, clearly that's not your first port of call. But when you do look at mid caps, which are the segments where you find some, possibility of growth and where prices haven't run up too much? How are you approaching the whole mid cap universe? Because they've had very sharp rallies as well. And investors will feel FOMO if they don't have some mid caps, right, in the portfolio.
Yeah, so we are a PMS manager, we are forced to look at mid and small cap, and that is my forte as well. For the last 25 years, I've been very, very much glued on to that space professionally as well as last 30 years plus, personally. So I like the mid cap space to pick and choose stocks. That's my forte. But at the same time, we have to be mindful of category aggregate valuation. So if you see small cap index today, aggregate basis trading at 3.1, 3.2 times, which probably was a 2007 kind of valuation, which I'm not very comfortable with. When the category is looking very expensive, that's where you need to be a little bit more cautious that space. And we have seen that 2017, 2007, or 2000, 24, all these occasions when the valuations become frothy, then there is more downside than, making returns. So that's where we are a bit cautious there. But at the same time, we see opportunities in, some of chemical companies, pharmaceutical companies, or CDMO players, engineering and capital goods companies, and those kind of, and even the small and mid cap banks. So we are positive on various names, but it is more selective. Yeah, it depends upon, or diagnostic names looks very attractive to us. So all these are preferred bets in our portfolios.
Okay, so those are some thoughts. George, just before you joined us, we were checking the markets and looking at the way gold has fallen. And it's fallen quite a bit this year, right? Down over 20%. And it's now beginning to show up in the gold financier stocks as well. So while you like, banks, NBFCs, what is your thought on the NBFC space in specific stocks like Manappuram and Muthoot? They've made a lot of money for investors as gold was rising. What are your thoughts now?
Yeah, so there's a lot of benefits because of the gold price movement. These finance companies got, because the loan to value ratio suddenly become lower, as the gold price keeps going up, and that was an inherent advantage. And also your growth was better. Now that can take a beating, if gold price corrects meaningfully, and 20% fall is not small, and we think that it can be relatively bet. And also you have seen that some sort of clear clamp on gold imports and gold related investments, which will happen through the ETF route or whatever, because it is going to put a risk to the exchequer. So we feel that definitely it is relatively, if you look at from a other asset class perspective, gold is not looking very attractive to us. And ultimately, you are paying to hold gold, and which doesn't fit into my scheme of things when I think about an asset class. But having said that, gold is a very well behaved asset class over a long period of time, so we can't shy from it. But when you say an asset class, ideally it should yield, either rental yield. You can think about real estate, earnings yield. You can think about equity. Something should yield per se from the asset class, which is not the case. So it is more of a safe haven status. The moment oil cools off and the geopolitical risk cools off, I think gold will cool off.
Okay, all right. So, and we've seen quite a bit of that. It's been quite the underperformer this year, down well over 20%. So, it's underperformed even the Indian equity market for sure, just looking at the price action. George, so what's your overall advice to investors? You're saying that macros are telling us that better times are around the corner. But when? I think that's the question. Or do you think the market can start marching higher irrespective of what's happening with this war? I mean, today was a very interesting day, right? You have actual strikes resuming between Iran and the US, and the oil market itself is not reacting. Oil is barely changed. I mean, just $1 here and there. And price action always tells you something, right? So, what are the next couple of
Absolutely.
months looking
So,
like to you, and what's your advice to investors?
so my thought is that when we look at a lot of data points from three different aspects. One is from the macro data points, global macro as well as domestic macro, how it is behaving. It is better off. That's what I was mentioning in the beginning, in the last 15 days. And secondly, we look at the fundamentals of company and the value, and then comes to the valuations, which is the safe part which any fund manager should look at. So all three aspects is far better placed today from a pockets which I explained earlier compared to what it was earlier. Market will look through these situations. Now, 2 quarters pain could be there because of the energy prices were higher, and those will be impacting the earnings of various companies. But companies which can pass on these aspects, companies which can benefit out of these situations are also there in the whole scheme of things. So we need to look at 2 quarters hence what will happen, or 3 quarters hence what will happen. So investors should ideally look at professional fund managers like us to invest with us, and also it has become very complex, right? Because geopolitics is working on one side, valuation people don't understand. People look at price points and stock prices, then valuations, and many a times you get carried away with what you see on the screen, but ultimately you have to look at how macro is improving, valuations are improving, fundamentals, how it is deteriorating or not. And it is a very, very difficult task for a retail investor. So give money to the professional fund managers and sit safe for the next 3, 4 years. Ultimately, India is a good growth story. It will compound, and India decade is coming, one of the best decades in my view. So it's going to be the next decade because of the flurry of money after meeting the basic requirements of roti, kapda, makan. You see that you have all those elements in your favor. So big amount of money flow into markets will happen. So you need to be positive on India, but need to be cautious on mid and small caps at this point.
All right, George, that advice is well taken. Thank you very much for joining us today and giving us a sense on the market where you're saying that perhaps better times are coming soon, and we really hope for that. Good to have you on the show today. Have a fantastic day, and we look forward to more of these conversations. Thank you.
Thank you. Thank you for having me here.
All right, well, with that, let's quickly check